Guys, thank you so much for joining me in this presentation today on bond maturity. Grateful for the chance to share with you guys this research that I put together. So, a little bit of audience participation. Let's do a show of hands if you are now or ever been the parent of young kids. Okay, great. What does this have to do with bond maturity? Well, stick around and you'll find out. Let me give you guys the cliff notes before I go into the details. If you're holding a portfolio that is mostly stocks, then at least historically, you may consider holding intermediate-term bonds. But if you're holding mostly bonds in your portfolio, you may consider holding short-term bonds. Before I tell you guys why, I want you to imagine this couple. They're looking into each other's eyes, it's Friday night, and they're saying, what are we going to do tonight? And if you're a young couple, the answer is pretty obvious. We're going to go out dancing at the club. We're going to stay up late. We're going to do shots. We're going to end up drunk at Denny's at 3 a.m. eating the Grand Slam. It's a pretty obvious answer to the question, what are we going to do tonight? But what if I told you that these two adults had a couple young kids at home? Well, now the answer to the question, what are we going to do tonight, totally changes. Now we're probably going to stay in, cook the kids a dinner, give them a bath, tuck them into bed real early, and then the parents are probably going to go to bed early too because they know the kids are going to get up early and wake them up, so the parents want a good night's rest. Now, I bring this up because when a lot of people talk about bonds and interest rates, they're only looking at the bonds in isolation. And just like with our family example, if you look at parents in isolation, you're going to get a different answer on what the parent should do if you don't consider the entire family. So again, most people don't invest in bonds as their exclusive investment in their portfolio, or at least they shouldn't. If we're going to invest in bonds, it's going to be part of a diversified portfolio of stocks and bonds. Now, this is very relevant because right now everyone is terrified of interest rate risk, duration risk, just like this guy. And a little primer, duration risk is interest rates are rising, so the value of your bonds are going to decrease, and no one wants the value of their bonds to decrease, so they're going to always opt for short-term bonds. But again, if we're doing that, we're looking at the bonds in isolation, we want to look at the whole portfolio. So let's do that now. So I looked at the performance of hypothetical, backward-looking, diversified portfolios of stocks and bonds. Stock data I use is the CRSP index. It's the US broad market. I looked at 3 different maturities of bonds, short-term, intermediate-term, and long-term. I made the hypothetical portfolios have allocations between 0 and 100%, increasing in 1% increments. And then the usual stuff when it comes to this sort of backwards-looking historical analysis. So rebalance every year, capital gains and dividends are reinvested, no consideration for transaction cost, et cetera. Risk is measured by standard deviation, the usual stuff. So the first type of time period that I looked at was one that let's call a normal interest rate environment. So in this type of time period, and this is one example, 1927 to 2005, interest rates started and ended the same. You can see in 1927, they're a little bit over 3%, and at the end of the period, they're at the same amount. Now, of course, there's variation in the middle there, but the reason we're looking at this type of time period is it's going to allow us to evaluate bonds of different maturities fairly. So let's do that now. This is a risk-return scatter plot, not quite an efficient frontier, but here we see the 78-year risk and return of the 3 different types of portfolios with the various equity weightings. As a plot point is farther to the left, it means less risk. As we move the plot point farther to the right, it's more risk. Investment return increases as we move up this chart. So here's 78 years of investment returns based on the type of bonds in the portfolio. This is the audience participation segment. What sort of patterns do we see in this data? Just go ahead and shout it out.
Everything's going that way.
Yeah. So as risk increases, so does equity allocation, and so does investment return. So the first thing we notice is that towards the far left of the chart, again, this is going to be the least risky portfolios. It's pretty much exclusively occupied by portfolios holding short-term bonds. And again, this is going to be a mostly bond-dominant portfolio. What else do we see? Let's take a look at the other end of the chart. Let's take a look at portfolios that are mostly stocks. So the first thing we'll notice is that at really high equity weightings, when your portfolio is a lot of stock, it doesn't really matter if you're holding intermediate or long-term bonds. The return is going to be pretty similar. So 75% stocks, 25% bonds in one example. But what's interesting here is that if you have a portfolio with that same equity allocation, again, 75% stocks, but you hold short-term bonds, you're getting less return, which, hey, it makes sense, smaller coupon, shorter-term bond, I'm going to get, a smaller interest rate payment. But you still get the same amount of risk. So by opting for shorter-term bonds, at least in this one scenario, we're not decreasing our risk, but we're decreasing our return. But that's 7 to 8 years of data. Nobody invests for 7 to 8 years, not really an applicable timeline. So I took the same data, chopped it up in a 30-year rolling, each plot point being a 30-year investment return. So again, audience participation time. What do you guys see here? So you're absolutely right. So again, the lower risk, and if I heard you correctly, the lower risk portfolios are the ones holding short-term bonds, again, showing up on the left side of the chart. And just as with the 7 to 8 year risk and return, the portfolios towards the top of the chart are going to be a mix of either intermediate or long-term bonds, not short-term bonds. But of course, that assumes normal interest rates. And given that we are currently in a period of rising rates, it's worth looking at something similar in the past. So 1940 and 1981, perfect example of the historical rising interest rates. Rates went from near zero, which they were recently for us, up to a high of more than 14% in 1981. Let's take a look at what those investment returns looked like. So audience participation time. What do you guys see here? Absolutely. Yeah, it doesn't. So in the previous chart, long-term bonds wasn't really a difference between intermediate, at least at higher equity allocations. Here, it doesn't look like we want to use long-term bonds at all. So probably not a surprise there. We all know long-term bonds are definitely risky when it comes to a period of rising interest rates. The other thing we notice is that, again, towards the far left of the chart, the portfolios that are going to give us the least amount of risk, and in this case, least amount of risk for the best investment return, are going to be those portfolios holding short-term bonds. And then for the most part, towards the higher equity allocations, it doesn't look like there's much of a difference between intermediate or short-term bonds. But again, that's 41 years of data, not really the most applicable timeline to most investors, so I chopped it up. Here's 15-year rolling, same time period, each plot point being a 15-year risk and return of a portfolio. Do you guys see a pattern yet? Audience participation.
It's like the same. The shorter duration is, I guess, outperforming with less risk.
Absolutely. So there it is again. Less risk for the portfolios holding shorter-term debt at lower equity allocation. And again, we can see the long-term bonds, not really a great reason to hold them. They're showing up towards the risky end of the chart, but lower, so a lot of risk for not a lot of return. And then towards the top, we actually have, again, a mix of intermediate and short-term bonds in the portfolios. So you guys already know the answer because you stuck around for the beginning, but here it is again. So it looks like, at least historically, if your portfolio is mostly stocks, it looks like intermediate-term bonds may make the most sense. But if your portfolio is mostly bonds, then it looks like a way to decrease the risk of your portfolio is to hold short-term bonds. So don't be like this guy. Don't be like this guy. Hold the bonds that make sense for your portfolio given the weightings in your portfolio of stocks. So remember, there's lots of family members involved. Don't look at just the parents in isolation. Look at the whole family, and that'll help you figure out which maturity bonds are best for your portfolio. Any questions? Yeah.
So I asked this question this morning. How do you
Yeah, that's
Is it time? Like you mentioned duration, for example. Most people don't liquidate their whole portfolio, at one point.
so that's an amazing question. And I didn't want to go on too much of a tangent because I only have 15 minutes. But standard deviation is sort of a weird metric for measuring risk, right? Because the clients don't necessarily come into your office and say, hey, my portfolio got 10% this year, and last year it got 8%, the year before it got 2, and the year before that it got 6, right? Like clients don't look at standard deviation, right? The only thing clients really care about is what happens when equity markets go down. This paper is actually, or rather this presentation, which originally was a paper that you had to submit, was actually much larger when I looked at not just maturity, but issuer as well. And the cliff notes were, you want treasuries, right? Because treasuries, on average, go up when equity markets go down. I had like a whole risk-return scatter plot that did like every maturity and every issuer. Basically, it's like treasuries, they show up towards the top part of the risk-return scatter plot. They're always going to give you the highest risk-adjusted return. And the reason why is because when markets go down, treasuries on average go up, whereas all other bonds don't do that.
Did your research include taking any income? Would that have made any big changes to your outcomes, do you think?
No, it was a total return analysis. So again, everything was reinvested. Any other questions? Okay. All right. Thank you, guys. I appreciate it.